around here oriented to what we do. Whether you're new to trading or just new to our group, welcome to the Opening Playbook. Our mission here is to be a bridge for new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights as timely analysis of what's moving the markets right now, trading education to help you build real skills beyond surface level tips and tricks, and live trade ideas, real-time recommendations you can act on immediately. Opening Playbook is a free daily live webinar. Your hosts of the show are Nathan and Graham. Nathan has over a decade of experience trading Forex, stocks, and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, overnight options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is also an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed wrap order option trades for cost-effective entries, as well as created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. He's also a husband, a dad of 2, and the copy chief here at the pub. Now, a lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We'll tell you the hard truth, which is that trading is complex and takes time to learn. But we make the learning process much easier. The Opening Playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We'll dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. Now, it's important to remember that you should never trade with money that you can't afford to lose. Of course, nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please don't trade with money that you can't afford to lose. And let's be ultra clear, any type of trading involves losing some of your trades. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we believe you should always follow. And here are some rules of the road to get you started. Stay calm, try to trade without emotion involved in your decisions. Go at your own pace, don't try to keep up with us or other traders, and ask questions freely. We really do want to help in any way that we can. And to help you get started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner I'm posting above. And for answering that quick survey, we'll give you custom content to better help you by using your feedback to improve our classes and education, and give you a free options cheat sheet, a digital, easy to understand options guide that will look something like this. Now, I'd like to give you some tips on using our webinar platform before we get started with our regular program. The button next to number 1 here, we call the hamburger button. That will collapse the green column on the left, and you can leave it collapsed because we don't use it for anything. Number 2 is the pause button. You can pause and resume the presentation whenever you'd like. Number 3 is the mute button. You can mute and unmute the presentation's audio. If you find that you suddenly lose audio during the presentation, make sure you haven't accidentally clicked or tapped on the mute button. Number 4 is the main announcements section, where trades that we take in the current session will be posted, as well as helpful links that can always be found there. Now, this section will only be visible if you're on a large screen. If you're on a mobile device, you won't see announcements here, but we do have another area that you can see them that we'll get to shortly. Number 5 is the toggle for going between light and dark mode, whichever you prefer. Number 6, the monitor icon will enlarge the presentation area without hiding the communications or chat area. Now, this button is shown in 2 places, and I highly recommend using this because it'll give you the best view of the presentation without hiding the chat from you. Number 7 is the picture-in-a-picture button. This will reduce the presentation to a floating window so you can do other work behind it, such as go to your broker platform on a mobile device. Number 8 is the full screen icon. This button will enlarge the presentation to take up the entire screen, covering everything including the chat area. Number 7 and number 8 may or may not appear for you depending upon what device and browser you are using. Number 9 is the low latency button. Toggle this off if you're having any audio or video issues, such as buffering. Number 10, all the way on the right, is the communications area. This is where group chats, announcements, and private messages will appear depending upon the tab that you have selected above. At the bottom, number 11, is where you'll type your outgoing message. You can press enter or tap or click on the green arrow to send it. Number 12 is where you can start a private message to a host by tapping or hovering on one of their group chat messages and clicking the double speech bubble icon that appears. Now, you can only private message hosts, not other attendees. At the top, number 13, that button will collapse the communications area, giving you a larger area for the presentation, but you won't see any of the communications that are going on. Number 14 is the group chat. This is where you'll read and write messages that the entire group can see, and this is the default tab that you'll see when you sign in. Number 15 is the announcements button. This is where you can see those same announcements that were in the larger area that we covered earlier, but this will be available whether you are on a mobile device or a larger screen. Number 16 is the private messages tab. This is where you can see any conversations that you have started with the hosts or they have started with you. And if you have a new message waiting for you, you'll see a red dot below this icon in the toolbar at the top. And last but not least, number 17 is the button that will pop out the communications area into its own window. This is useful if you have multiple screens and you want to go full screen on the presentation and view the chat in a separate screen. Now, we have a version of this guide that I just went through that you can view on your own. The URL to get to that guide is marketspg.com/wisepub, and there's now also a link to it in the announcements section. And that's it. So once again, welcome to Opening Playbook. Don't forget to complete that survey to get your free cheat sheet. And now we're going to play our theme song and get to the regular show at the top of the hour.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The Markets Playbook is finally here. Opening Playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with the hawk side. Plays in a live display. Every move counts in the game they play. Opening Playbook, we're ready to roll. Daily moves that fire no confusion, no spinning around. With every trade, they set the tone, making big calls on their trading phone. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everyone. Welcome to the opening playbook for Friday, April 10th. Happy Friday to everyone. I hope you're looking forward to the weekend coming up and a little break from trading madness. But it's always good to refresh over the weekend and come back with a fresh take on Monday. Of course, that depends on what the news looks like over the weekend. But
Sometimes that can be a very fresh take,
yeah,
like as in a whole different market before us
right.
by the time it comes back on Monday. But we will see. Hello, everyone. Happy Friday to you folks. Feels like all of a sudden it's kind of been a like short, fast, easy week. It's almost like when the market is up 4% on the week, things feel less stressful. I don't know, maybe it's just me, but it feels like the last time. Sometimes when we get to Friday, it's like oh Lord, please let the bell ring on Friday and have the weekend change things. But this weekend it's been mostly up, or this week rather, and obviously last week really too. It just started so ugly on that Monday that I think we had some PTSD that we had. It took us till Friday to kind of get through. But
It wasn't easy though, with like World War III looming or
well,
whatever.
exactly. That's what was so chaotic. It was technically positive. It just didn't feel very positive.
Yeah.
Right now, we are very neutral. If you guys were on the members meetup, we had our highest neutral rating that we've ever had on the intraday basis, and well, the market's at 0.03% right now. So again, I'm not going to say that there's not going to be a headline or a pop. Yesterday, I felt very, very confident that we were going to be neutral. We grinded straight neutral until about 11:30. And then we got that pop. So we finished, fairly positive. Again, yesterday I heard some comments like, oh, wow, the market is, ripping. And it's like, well, it finished 0.58% after we've had like 3% days. So it wasn't crazy, but it was more directional than I thought. I thought it would finish below 0.5%. It finished above 0.5%. So, fair enough. The market beat the range that I expected. And I expect more neutrality here outside of Catalyst, which I'm sure that we will get, because this market is absolutely loving catalysts right now, although it's not reacting to all of them. So what I want to do here, I want to just walk you through something that I find interesting, and this is really part of my beating of the drum that I've been doing now for the last 2 years. And sorry for the people who were just in the members meeting who heard me mention the same thing, but I have a core belief that the market cycles are changing, and especially since zero DT options, but even before that, going into weekly options as they were gaining more and more popularity, into 2018, 2019, they were gaining a ton of popularity. And I think that has made the market cycles move more quickly. I think that's why we're seeing more like V-shaped recoveries just in the last couple of years than we've seen in decades combined. And so what I want to do is just show you the example that we have today of that V-shaped recovery. and give you a little extra context for how that has looked in the past. By the way, speaking of V-shaped, we are now in technical terms a full bullish market. We are above the 8 EMA, the 20 EMA, the 50 EMA, the 100 EMA, and the 200 EMA on the S&P daily chart, which is pretty wild because 4 sessions ago we were below most of those. And we are now, in technical terms, fully above every one of those EMAs. So that's wild, but it goes to what I want to talk to you about, which is this V-shaped recovery and what that actually means. So let's just take a look at the SPY here. Whoops. First of all, let me ask in the chat, anyone seeing the V? Or let's start there. Are we all on the same page? Anyone see the V on the S&P 500 chart right now?
I see two of them actually. Yeah.
Yeah. Well, there actually is, but yeah, significantly there's the current one
for sure.
And I think what retail traders have a tendency to do is think, oh wow, that's too fast, too much. Let's short. It's overextended. And what I want to walk you through today is that actually this V-shaped recovery, and I'm gonna purposely talk out of two sides of my mouth here at the same time here. But while this V-shaped recovery is not something that I'm really excited to pick direction on quite yet, and so I'm still considering myself neutral, and there's not really enough volatility to take those neutral trades. So I'm pretty much on the sidelines outside of like the mechanical stuff and the long-term stuff. But what I want to show you today is that the V-shaped recovery, while most retail traders look and want to get short because it's overextended, is actually a very good indicator of continuation. One way that we can look at this is we can look at our handy dandy streak indicator, which tells us how many consecutive days we've had. If I turn this on, I have it right now set to 7 consecutive up days or 7 consecutive down days over the last 200 bars. That means over about the last year. Well, you guys can see up here what happened based on the close of yesterday has happened one time in the last year. John says eventually it's going to fill the gap. I don't know. I don't know, John. We'll take a look here. Tell me if you're still convinced that it's going to fill the gap after we go through. I'm not convinced. I'm not saying no. I'm just saying I think exactly that mindset is a little dangerous when we get ripping on some of these V-shaped recoveries, and I'll show you why. But can everyone see this? This is 7 consecutive days of closing higher. This has happened one time in the last year. Now, if I set this to 1,000 candles looking back, we get about 9. So we actually get 7 up days in a row once or twice a year. Now what I want to do is I want to actually go back and look at those occurrences. So let's just scroll back. Well, the last one was also during a V-shaped recovery. And you can see it was a pretty good indicator that things were going higher. Now, it happened in relative terms a lot deeper into the correction. Oh, John, there's hundreds of gaps that were never filled specifically on the S&P. But on the SPY here, this was early into the range. Here's 2 gaps for you right here, John, that were never filled. May, June, 3 in a row there that were never filled. These other ones were less V-shaped, as you can see, because we didn't get the full, 8-10% correction, but they were still pretty decent continuation signs. This one is going back to the April 24. I wouldn't take these ones with as much emphasis, because they were just kind of more grinding in a bullish market. They weren't, recovery runs, but you can see 7 days in a row, even in these cases, we're mostly pretty bullish. Our next V shape looks a little bit closer to our current one. This is 2023. John, how's that for a gap that was never recovered? We're not still waiting for S&P to come back down to 446. I mean, this thing, there's a gap that never even came close to being recovered on the S&P right there. And I'm not picking on John, by the way. Me and John are dear friends. I'm just highlighting because he's the one who asked the question that this it is a common thing that like, oh hey, it ripped, it over recovered, it gapped up. We should be net bearish until it's filled, but that's often a misnomer, especially after pullbacks. Here's another one. This one again, maybe not quite the V shape that we're talking about, but you can see it in October. That 7 run in a row had pretty good momentum. After the first set of close, we went up another 4 or 5%, ended up going sideways. If I go back, here's the COVID one. Now, interestingly, we actually never got the 7 days in a row, but we got it way later in the run, and it still followed through. But let's examine this one, because it looks pretty similar to what we have right now. Big flush, big opening gap here. This was that gap up. If you guys, I don't know if you guys remember, this was the first move up. So we went here, just a small 9.27% from previous close to next, and we never filled any of that gap. We literally had a 9% gap between close to close, and the most we ever did was kind of center on the candle the next day. So John says, may have another. Yep, John, you may. Here you go. We're not trading the S&P down for this 234 gap. The lows gapped up, never looked back. So the only point I'm trying to make here, as I beat this dead horse to oblivion, is that these super aggressive V shapes usually don't ever come back. It's a very common misconception that when the market pulls back and then it gets ahead of its skis, it's going to come back and test those lows. It almost never does, actually, under these kind of conditions. And so let me scroll all the way back to where we are now. While I'm not convinced yet of this market by any stretch, because sometimes you will see what looks like a V-shaped recovery and then a deeper correction, I think erring on the side of it went up too fast, therefore it must come back down, is a really dangerous game to be playing. So how do you trade it? Let me ask you in the chat. How many of you are fully confident that the V continues? And I don't know what shape this is, but it goes from a V to a higher on the other side. Dave, what's this shape? Check mark?
Check mark.
How many of you are convinced that we're going from a V to a check mark versus how many of you are very nervous that, we're gap filling or potentially continue or we still have a lot of bearishness? Because right now, what I would say is that even though I'm net neutral and I'm looking for some neutral trades, if I can get the volatility isn't there. So in my opinion, the best way to trade it is exactly the opposite. Let's price it out. What do I mean by exactly the opposite? I mean, I'd love to trade neutral in the short term. I don't think it's available, so I'm going to trade non-neutral in the longer term. And I'll actually show you the trade that I just put on. Instead of giving you a theoretical example, here's the example that I put on. So that is a reverse iron condor or two-way trade. And my numbers there are 7,000 and 6,500. So 7,000 is my, not 70,000. That would be an aggressive trade. Oh, I'm on the SPY. Okay, let's go to the SPX so the numbers make sense. 7,000. There we go. and 6,500. So this is a fairly big range. You'll notice that my downside range is a little bit bigger because I'm just slightly more biased that in the 2 months after a V-shaped recovery, we have the potential to hit all-time highs. My risk reward there is not amazing. I would like it to be better, but there are a couple of reasons that for me, I'm willing to take a trade like this. Number one is that right now, I think volatility is priced about as cheap as we're going to kind of see it here in the short term. Because if we move up, VIX will come down, but we won't be able to even trade the downside range because it'll be too far away. But if VIX comes down, then the volatility will be higher, and I'll have to pay more to trade a two-way trade. So I think we're probably in about as good of a zone as we're going to get for this level. Now, what I did, instead of trying to take a neutral trade in the short term where there's no volatility, I flipped it on its head and took a non-neutral trade over a little bit longer term, going out to June 18th. So basically what that does is it draws a vertical line in the sand along with my horizontal line in the sand right there. And it says either the market is going to flush and get below here over this time range, which obviously would be in pace with what we've done so far, or this V shape will continue. We'll get our check mark here and we'll be above this level. Okay. And historically speaking, most V shapes continue at a similar pace over the next couple of weeks to months. And so it would easily cover that amount of ground to the bullish side if that happens. Now, let me let you in on a little secret. I don't really expect to win this trade because I don't really expect to hold it here all the way to June 18 for one thing. And for two, if you ask me what I really expect, what I really expect is price to actually end up somewhere similar over this time frame. So with that being the case, you're probably thinking, okay, well, Nate, why on earth did you just risk 40 grand if you don't expect to win the trade? Well, two reasons. Number one, if you guys are familiar with my stacking approach in this account, well, then you might know that I always have about 6 figures deployed with a defensively bullish mentality. And so what that means is that as long as price stays in this range, it's not moving too fast, I'm going to win a whole bunch of trades between now and June 18th. And so this is you've heard me say I like to hedge without hedging. This is my hedge without hedging. If the market stays within this range, I'm going to win a whole bunch of trades on that account between now and June 18th. If it rips higher, I'm going to win a whole bunch of trades in that account, plus this trade on top of that. And if it rips lower, at least I have a hedge. At least I'm going to make some money on that trade between now. If my other position, which is stacking defensive trades, is starting to bleed capital, well, now I do have a hedge built on top. And on top of that, I also have my June 30th trade, which is an even bigger box when volatility was high, which that trade makes over 100% if we stay in the same range between now and June 30th. The range is basically like this. So what I am trying to show you is that this is not really a prediction trade. This is a portfolio trade. And sometimes, especially condition-based, portfolio trades make a lot more sense than directional trades. You look at your account and you say, okay, what scenarios should I defend against and should I try to be opportunistic with, given not just where the market is, but where my portfolio is? Okay, does that make sense? So the reason I showed you this trade isn't because it's a big, bold prediction. It's because this is the way that I look at the market right now. With the whole preface of, man, I really don't want to trade right now. I really don't want to take short-term trades. I'm kind of neutral short-term, but this is what's going on. What I actually did is I ended up taking a portfolio trade, not even a market prediction trade. And this is how I constructed it based on what I have open right now. Yasmin, these two white lines, if you remove this middle line, and you remove this box, these two white lines and this yellow line is the trade drawn on the chart. The market has to be above 7,000 or below 6,500 by this vertical line. Now, I probably won't hold it until then, because if we're net neutral and I'm bleeding cash, I'll be making money on my stacking positions, and I'll just either, exit it and set up a new trade, or, maybe I'll be less worried about the market volatility at that point, or maybe VIX will be higher, et cetera, et cetera, et cetera. I'll manage it maybe halfway through the trade. If the market flushes, I'll probably close it early and say, okay, well, if it bounces back, I'll have turned a losing trade into a winning trade. And if the market rips higher, I'll do the same thing. I'll close it early. So most situations don't have me holding this trade till June 18th.
One thing to mention is that this is a more expensive trade than we usually take in opening playbook. It's going to be $1,400 at risk.
It should be $600 of risk. Let me.
You had it at 14.
So it should be a $14 credit on a. Do I have that at 20 wide?
You have it at 10 wide.
Or at 10, yeah, at 10 wide. Let me see. Let me make sure. It should be.
Yeah, something seems off there. Because you also
be $600 of risk.
You also have you're buying the 6,500, and I don't know if that's right. You're buying the 6,500 and selling the 6,510.
Right. Because what I'm doing is a reverse iron condor, but I'm doing it as credits in case I let it expire, because I have so many contracts on there that in case I let it expire.
Oh, I see it. Yeah, I don't want to pay the extra fees.
Strikes. Yeah. Maybe I should have started with the structure, because it is a little bit different. So guys, what I'm doing here, let me just make sure everyone's following. If you did this at one contract, you'd have $600 of risk. So still a little bit more expensive. But what you would get, let me get my pen here. We'll make this make sense for folks. Next time I'll start by explaining the trade before I post in a complicated trade in the chat, folks, I promise. All right, let me get my pen out. It pops up. There it is. Okay, so here's what I did. 6,500 is my line in the sand. Usually I would do that as a put debit spread directionally because of exercise risk and a couple other things. Here, I had 75 contracts on. And so if I want to let this expire, I don't want to pay the exercise fees on 75 contracts. So I actually flipped it around and I did the call side on the bottom there, and I did the put side on the top. So what it actually looks like is call credit down here. And then if you flip it, let me see my numbers here. Yep.
It's 7,900, 6,990, or 7,000, 6,990.
Okay. And then 10 wide on put credit up here. So what this trade means is I'm collecting, quote unquote, collecting. I don't like using that term because it's really the same as a debit spread. It's just the only reason I'm doing it is exercise fees. I'm collecting credit up here for if the market finishes above 7,000, I'll keep that credit because these puts will expire worthless. I'm collecting credit down here. If that trade wins, the call side will expire worthless. Now, we would typically do this with debit spreads, but the math is exactly the same. It's just flipped around. The reason it's $600 of risk is because if I get $14 in credit and it expires in between, I'm losing $20 because I'm actually paying $20 back. And so your 14 credit against the 20 max risk actually leaves you with $600 of risk. Okay. Does that make sense? Or have I lost everyone and no one's ever coming back to opening playbook forevermore after this trade?
No, it's right. It makes sense.
This is really not a recommendation, though. This is an example of a portfolio trade that I'm doing because of what I have in this account. That the example is meant to be specifically, I actually don't want to make a prediction trade, but because volatility is low and I can't get credit for trading neutral, what I can do is I can flip that on its head and kind of protect myself against the kind of 6 or 7 different scenarios that I think make sense for my own account. Kenny said, "When is Graham back?" Uh, yeah, I need to retire after this week, confusing the daylights out of people.
I'm spelling it out the kind of traditional way we type it for people because there are a few requests in there.
Here, I'll
I got it
let
right
me
here.
let me also screenshot while you type it out. I'll also
Okay.
screenshot it. The reason uh, the reason I think this might be easier is because if I show it to you, there's in the chat. If I show it to you here in my account,
Yeah, it'll show you the buys and sells and all that.
yeah, I would. But if I show it to you this way, you're going to see 77 other orders and probably be even more confused. So I thought maybe if I just screenshot the individual one. Okay. So hopefully that makes sense. Kenny and the rest of you are waiting for Graham to get back so you don't have to put up with this anymore. But the example there is meant to be a portfolio trade example. The entire idea I was trying to give you today was the difference between a prediction trade and a portfolio trade. To me, this is a portfolio trade. In other words, if I'm you and I'm watching opening playbook, I'm really not taking this trade unless you have the same kind of risk allocation and the same kind of trades that I have in my account. Because I don't even expect this trade to win, but I think the risk reward is good enough for the scenarios that I have open in my account. Oh, nice. Yeah, Sandisk is. I'll take a screenshot of your comment there and send it to him. He is responding to me over Slack from the Argentinian forest. Is that where he's at?
I don't know actually where he's at.
I think Argentina. But I might have that wrong.
I don't know. He didn't want to tell me because he thought I might mess with it in some way. No, I just don't know. A couple things to mention real quick while we're on the Graham topic. So he does not have internet right now. He could not give us the gold trade for the morning. He said if you're interested in his weekly Friday gold trade, watch his public or general Telegram channel, whichever way you want to call it. Same thing. Watch his general Telegram, and he will post the trade in about an hour. If you don't have Graham's general Telegram, or Nate's for that matter, I will post them right here. These are Telegram links.
Dave, while you're doing that housekeeping, can I ask also, did anyone get filled on the O&O entry yesterday, the overnight options entry? I was on closing playbook, and it did dip a little bit, but I was on closing playbook, so I didn't really get to work the order to try to get in. So I did not get in, but I would love to check because I'll add it to the track record if people got in, but if people didn't get in, then I'll skip it. Well, 4 for 4 say no. 5 for 5 say no. Well, okay, never mind. 6 for 6 say no. Okay, that's okay. I didn't want to chase that one. If you couldn't get filled for the right price, $1 of cushion did not seem like enough to take that trade. So if you got filled at the right price, great. If not, I think it's the right move. We are now on pace for 8 days in a row. By the way, just in case you guys are curious, this is 7 up days in a row over the last 1,000 candles. So about 4 years. There are 8 occurrences of that. If you go to, okay, well, what about 8 days in a row, which would include today, you go down to 4 occurrences. So it's about 50-50. When you get 7 up days in a row, are you going to go to 8? It's about 50-50, historically speaking, over the last 1,000 candles, just in case anyone was curious about where those odds end up for whether today finishes bullish as well.
There you go. Question about 60 minutes. So 60 minute will still happen because Florian will put that trade out. If it qualifies, we did get the opening range game plan this morning. We just didn't get an actual trade yet. And we're approaching the time of no return on that. So if we don't get one in the next few minutes, then we won't have one for today. But Flo should be putting out a message one way or the other, whether we're taking a trade or not in the next few minutes. Just keep an eye on the 60-minute Telegram for that.
All right. For those of you who got filled, I'll put a note. I'll put a note there in the tracker that a couple people got filled if they paid more, but not an official entry because I did not. Great job though for those of you who worked it and got in there.
Um, Looks like I might have the buys and sells flipped on the calls when the way I posted the trade. Let me see. Yeah, we should be. We're selling the 6550, right? I mean the 6500. We're selling the 6500.
Sorry, you're talking about the one
The
that I put
SPX
in?
trade, yeah.
Yeah, you are going to sell 65 and buy
Yeah. Buy
65.10
six.
because you're
Yeah, it's actually written the way that um
the way
the
that I
way that
copy and pasted it, the way that Schwab
yeah,
posted is sometimes a little funky
it
too.
is. Yeah. Yeah. Let me repost it and I'll get rid
Their
of that
copy
one.
and
Yeah.
paste is a little awkward sometimes. So
I should go with what I know and not what I see in the thing. All right, there we go. And then the other thing to mention is Monday, if you want to do that real quick.
yeah, well, you guys, if you're following my Telegram, have probably heard me mention it a couple of times already. How many of you are signed up for the Monday webinar right after opening playbook? Dave just posted the link if you're not. I am going to do something a little bizarre. I'm going to host I guess what you would consider a competitor in if we use those terms, but
Not
we don't
really.
really use those terms because they're kind of weird in our world. But the guy I'm going to have on Monday is really interesting. He's an old school stock guy. He's not old. He's fairly young, but he's an old school guy. He comes from the European institutional world. Has done some incredible research specifically on small caps. It's funny. Today I asked him. I said, "Hey, our legal team needs to verify all any of your stock gains." Because he has a couple in there that are like he made 5,000% or 17,000% on a stock. So obviously our legal team is like, hey Nate, we can't go around telling people that people made 17,000% without verification. And so I texted him and I said, hey, can you send me any statements for making 5,000% or 17,000% on these individual tickers? And he said, well, I can send you the entry, but there's no exit because I'm still holding, which is just so foreign to me because it's like, well, you entered it 13 years ago, but yeah, he's still holding, but that's the kind of approach it is. So I'll show you, I'm going to take on that approach a little bit differently. I'll explain exactly what I'm planning on doing on Monday, but the research is really fascinating. It's not for everyone. It's almost the exact opposite. I said, here I am. I trade, option structures on like the 10 most liquid stocks in the world. You trade underlying stock on like the 10 least liquid stocks in the world. So, it's very two different sides of the spectrum. But I think it's pretty fascinating, and we'll walk you through. The cool thing about Monday is it's not like hey, here's this black box thing. It's here's the criteria he uses. Here's a couple of the stocks that are on the list. And so you'll get, I think, a lot of value on Monday. So hoping to see everyone there. Dave posted that sign up link. It's also in that little green bar up there at the top. We called it the Invisible Stock Summit. There's a very good reason it's called the Invisible Stock Summit. Pretty fascinating stuff. And so really looking forward to that Monday right after opening playbook. I hope I'll see you all there.
All right. What we're going to do now is we are going to finish the credit spread basic training that we started on Wednesday and didn't have time to get through all 5 types of credit spreads. So we're going to talk about butterflies and calendar spreads today, which probably is strange because I'm starting with iron condors on the screen. But the reason I'm doing that is because I just want to do a very quick review of iron condors because butterflies are really, in my mind, a specific type of iron condor. They are a kind of narrowly defined iron condor. So I just want to go over the iron condor real quick as a refresher for those that were here or anybody who wasn't here, because we're going to compare and contrast them a little bit as well. So with the iron condor, the iron condor was a vertical spread call spread and a vertical put spread put together. is a vertical call spread and a vertical put spread. And the profit zone is between the two spreads, right? So we have two calls and two puts. The profit zone is between the two spreads. Uh, the all of them are using the same ticker. It's one call spread, one put spread. All of them have the same expiration date, and we have four different strike prices. So what does that look like? It looks like something like this, where we're buying a 280 call, we're selling a 270 call, we're selling a 230 put, and we're buying a 220 put. And when we do something like that, the kind of little mental trick that I like to use and show people is when we're trying to figure out, well, where do we want the stock to be? Do we want it to be above 280 or below 280, above 270? What do we want? When we look at the two calls, we draw a line from the buy to the sell call and make it an arrow. And we do the same thing with the puts. We draw a line from the puts to the sells. And that's the direction that we want the stock to go. We want the stock to go above the sell put and below the call put. And so we want it in this box in the middle. And that's why we typically call this a box trade, because we draw a box in the middle. We want the stock to be between 270 and 230 for us to get our full profit from this. So when we do that, our profit zone is in between these two spreads. All right. So that's where we're looking for the price to go. What does that look like on a chart? Well, I'm going to do it real quick here because, again, we covered this already the other day. But if we have a line here, let's say we expect it to be within 262, we're going to have a spread from 263 to 262. And if we expect it to be within 253, we're going to have a spread at 253 and 252. And what we want is our profit zone is going to be in here, right? Our profit zone is going to be in here. And then we're going to have a full loss zone outside of our spreads on both ends. So we have one full profit zone in the middle, two full loss zones on the ends, and we have this little kind of buffer zone here where we have either a partial win or a partial loss, depending upon a few factors, if it's between the strikes of either of our spreads. So an iron condor is what we call a box trade because, again, we're trying to keep it within this box here is our profit zone. We expect that this trade or that the stock is going to stay within a particular box. And the box can be, evenly weighted up and down. It can be a little lopsided like this one looks. It doesn't really matter. But the point is that the profit zone is going to be between the strikes and our full loss zones are going to be outside the box. I'm sorry, our profit zone isn't between the strikes, it's between the spreads. And our full loss zone is going to be outside the box, outside the spreads. So that's what a regular iron condor looks like. And this up here is going to be two calls. Whoops. Oh, let's be a little more specific. This up here is we're buying the 263 call and we're selling the 262 call. And then down here, we're selling the 253 put and we're buying the 253 put, right? So again, you draw your lines from the buy to the sell. We want the stock to go in this direction or in this direction. And so we have that box in the middle, right? So that's our profit zone. So that's how we construct a normal iron condor. Now, let's talk about butterflies. Whoops. Well, this is what the iron condor will look like in the broker platform, just real quick, right? So we have two calls, we have two puts, we're selling the high put and we're selling the low call to squeeze it in the middle, right? Okay, so let's get to butterflies. So what is a butterfly? Well, a butterfly in my mind is a special variant or a specific case of an iron condor that uses a common strike for the two options that are on the inside. So it's the same ticker, just like the iron condor. We're doing vertical spreads, two vertical spreads, just like the iron condor. However, with a butterfly, they could be the same type, meaning they could be all calls or all puts. And then again, they have the same expiration date. But the big difference here is with an iron condor, I'm sorry, with a butterfly, we only have three strike prices because we have a common strike price in the middle. Two of the iron condor strike prices become the same strike price. So what does that look like in practice? Well, um, we're buying a 280 call and we're selling a 270 call, then we're selling another 270 call and buying a 260 call. So it's very much like the iron condor where we're buying at the top and the bottom and we're selling two calls in the middle. The difference is with an iron condor, your middle two cells are different strike prices. And with a butterfly, they're the same strike price. And you can see on the right, we typically indicate this when we type this out. We typically indicate this by saying that this is times one, times two, or sometimes we don't even put the times one. We just put the times two for the one that's different. So we will typically type this out as, buy to open the April 10th Apple 280 call, sell to open the April 10th 270 call times two, and buy to open the April 10th 260 call is typically how we'll type that out. And you'll notice the middle strike, the 270, is shared between both vertical spreads, and that's what makes it a butterfly. And I'm going to give you my horrific drawing skills right now. That's what makes it a butterfly because it has that kind of fat center of the double strikes in the middle, and then the wings are the individual strikes on the outside. So this is your buy strike, this is your two sell strikes, and this is your buy strike, right? So that's kind of what makes it the butterfly, although that's probably the worst butterfly drawing in history. All right. I have two artists in my family and two singers in my family, and I can't sing or draw. So little tidbit on David Mound. Okay, so that's how we construct this. So let's take a look at what that looks like on a chart. So if we do this on a chart and we do kind of the same overall principle that we had with the iron condor, which is that we expect the stock to stay somewhere in the middle of a zone, right? So with the iron condor, we created one profit zone in the middle, and we're doing the same thing with a butterfly. So with the butterfly, let's say we expect it to stay between, let's say we expect it to stay between 262 and 256, just as a random example, right? We expect it to stay between these two lines. So what we're going to do is we're going to buy to open this 262 call. And we're going to buy to open this 256 call. And then to hedge those, we are going to sell to open 259, which is right about here. We're going to sell to open 259. But we're going to do this with calls, and we're going to do it times two options. So for every contract that we buy of this call, we're going to buy one of this other call and two of the sell calls. So it's going to be a ratio of 1 to 2 to 1, no matter how many we buy. So if we buy 10, if we want to do 10 of these spreads, we'd buy 10 of the 262s, 20 of the 259s, and 10 of the 256s. The number doesn't matter. It's really the ratio. It's 1 to 2 to 1 that matters. And what we've created here is the same profit zone, essentially, roughly the same profit zone. Roughly the same profit zone here. However, how much we make at the ends of this will be different than the iron condor. So how much we make in, say, whoops, how much we make in, say, this zone here. And well, actually, how much we make throughout the whole thing will be different because, and you'll see in a minute, what we wind up with is we wind up with a really big payout here, and we wind up with smaller payouts here and here compared to the iron condor. So the iron condor gives us a consistent profit up and down this zone. The butterfly gives us very big profits here and smaller profits here and here compared to the iron condor. What we call this is we call this pinning the price that we expect to pin the price. We're pinning the price at 259, which means that if the stock is at 259 or very close at expiration, we will get a big payout. What we give up for that is some payout on the outside of the range, right? So we'll see that in a second. Let me clear this, or let me see if you have any questions about the chart before we move on. I don't see any. Okay. PO, we talked about the gold trade earlier. So if you watch Graham's traveling and he's away from internet right now. If you watch Graham's general Telegram channel, he's going to post a gold trade when he has a chance in the next hour or so. All right. So let me move on and I'll show you kind of how that compares. Well, first, here's how it looks in your brokerage platform. I keep forgetting I have these slides in here. So here's how you would do this in your brokerage platform, and notice the quantity here where we have the 2 on the sell for every 1 that we have on the buys, right? And we only have 3 different expirations instead of 4 because we're sharing that middle one between both spreads. The other difference is that this can be a debit spread versus an iron condor is almost always a credit spread. We're not going to get too much into the difference between credits and debits right now. We talked about it a little bit on Wednesday. If you want to go back and watch Wednesday's opening playbook, you can see the basic spreads part of the lesson. You can see the vertical, the iron condor, which we just went over a little bit, and the reverse iron condor were all part of Wednesday's session, if you want to look at those in the replay. All right, now let's look at this. So what we have here is the comparison between the profit and loss zones on an iron condor and on a butterfly. Now, of course, you can play with the strikes and you can make some of these wider, some of these narrower, some of them taller and shorter by playing around with it. But this is kind of the general gist of what you'll get with an iron condor compared to a butterfly. With the iron condor, you get that much wider max profit zone within the green zone, and you get a little bit more, I would say, deeper, kind of gradual working your way toward your loss within that partial win, partial loss zone. On the butterfly, you get a much steeper climb to a higher profit. This is a much higher, it's a little hard to tell on the graphs because they're not really lined up. But if I were to move this base white line up to match this base white line, you would see a much higher profit on the peak. This is where what we call the pin price, right, is the middle of this. And so as you work your way toward the middle of that profit zone, you then have a higher profit potential with a butterfly than you do with a condor. And you generally, within the same, ticker and price structure and volatility, you generally you have more profit potential with the butterfly than you do with the condor. But if you're less accurate on where the price is going to pin to at expiration, then you risk kind of a quicker path to lower profits or losses with the butterfly than you do with the iron condor. As we saw yesterday in closing playbook, if you were here for that, in certain conditions, if you play around with the butterfly, you can get overall better uh, combination of risk reward and high profit, low profit, and all that in certain conditions with the butterfly than you can with the iron condor. It just depends on how the option pricing is, where the volatility is. It depends on a number of things in the market, but things kind of at an average mid level across the board and no kind of radicalness going on. This is generally what you'll see. You'll see higher profit potentials with the butterfly, but wider profit potentials with the iron condor. And typically, but not always, again, we're usually taking iron condors out of the money where like we don't really think it's going to stay where it is. We don't know exactly where it's going to pin. So we're giving ourselves kind of a wide zone to make a move, but not a huge move. Um, with the butterfly, it's usually at the money and we're expecting it to stay very much where it is. And so we're kind of pinning it at or near where it is right now and basically betting on no move. Now, that doesn't mean there can't be any move, or it doesn't mean that we might not take a butterfly a little bit out of the money, or in the money, but we generally are taking it kind of close to the money. And this one, we're generally taking a little bit out of the money. So guidelines on when to use them. I'm not going to go through all of this again because we covered a lot of this just now, and this will be here for you to reference. But some general guidelines here, not hard and fast rules on when you might look to use a condor versus an iron condor versus a butterfly spread. So you can see this again in the replay or in the slide decks. We'll be posting this in the slide deck document inside of opening playbook members area. So let me see if there are any questions about butterflies before I move on to calendars. Yes, Richard, we would employ the butterfly as well as the regular iron condor when we don't expect, well, I shouldn't say that. We would we would employ the butterfly when we don't expect a lot of movement from the current position. We would employ it really either one when we don't expect a lot of movement, um, or when we expect it to land within a zone. And if we feel like we can accurately call like the real actual price it's going to go to, we might use a butterfly. If we feel like we're going to need to widen that zone and kind of cover a bigger range, you generally would use an iron condor. But again, it's good if you're going to take either one of them to compare them and see which one is giving you better range and better profit for how the options are priced. So generally speaking, if you're ever going to take a butterfly or an iron condor, it's the decent idea to compare them if you have the time to do it. And the best place, in my opinion, to do that, although Con mentioned if you put the trade um, in TOS, you can add a simulated trade. We use option strat a lot, as you'll see in opening and closing playbook very often, particularly closing playbook. We use optionstrat.com to kind of graphically visualize and predict where our profit and loss zones are, so we can easily move things around and change them around and compare which one is better based on the current environment, meaning volatility, expected movement, the pricing on the options, all of that kind of stuff. Okay, so let's move on to butterflies. I'm sorry, let's move on to calendars. So calendars are going to be extremely different from any of the other four that we covered: verticals, iron condors, butterflies, or reverse iron condors. The big difference is all four of the previous ones, we were trading primarily price action, meaning we were making plays on whether the price was going to go up or down or make a big move or a small move, right? So we generally do a vertical if we expect that it's going to go in a particular direction. We do an iron condor if we expect that it's going to make a small move and stay within a zone. Same thing with a butterfly. And we do a reverse iron condor if we expect it to make a big move and go outside of a box, but we're not sure which direction it's going to go in. With calendar spreads, we are primarily trading the volatility. We are not trading the price. Now, Price will affect the calendar as well as time, but we are generally trading volatility with a calendar spread, time and volatility, more so than time and price movement. So when we do this, we're doing uh, a two-leg spread, just like a vertical. The big difference is in a vertical, we have the same expiration dates and different strikes. With a calendar, we have the same strikes, but different expiration dates. So everything is the same between the legs of a calendar spread. The ticker, the type, meaning calls or puts, and the strike are all the same. Both options are the same ticker. They're both calls or both puts, and they both have the same strike price. This is the only trade we're talking about in the last two lessons where the strike prices are the same, although they're the same in part of the butterfly. This is the only one where all the strikes in the spread are the same. The only difference between them is going to be the expiration dates. So to look at that, here's a call calendar spread and a put calendar spread. In the call calendar spread, we're buying the 17 of April 260 call, and we're selling the same 260 call, but with an April 10th expiration. And the same if we use puts. We're selling a 24 April 200 put. I'm sorry, we're buying the 24 April 200 put, and we're selling the 17 April 200 put. Strike prices in both of these spreads remain the same, as well as the tickers. The difference is we're buying one date and we're selling another date. And regardless of whether we use calls or puts, we are always buying the later date and selling the earlier date. Or you could call it further and closer, whichever verbiage you want to use. You're selling the one that's going to happen, that's going to expire first. Now, let's take a look at that on a calendar. Well, I mean on a chart. Well, that's a little harder to do because we're selling and buying the same ticker, right? So we're at 258.88. We might buy and sell the 259, but the difference is we're buying to open the April 20th and we're selling to open the April 17th. They might both be calls or both puts. Doesn't matter. We're still going to buy the further one, the later date, and we're still going to sell the closer date. Now, what's going to happen? Well, let's say the price doesn't move at all. We are still going to make money on the difference in time decay between the one that expires sooner and the one that expires later. And if volatility moves in our favor, then it will go even better for us. So let's talk about what that actually looks like in a way that we can visualize it, because it's hard to visualize time here and what that does to the value of our options. So I like to look at calendar spreads this way instead of on a stock chart. So what we have here is we have two stocks. We're buying one and selling one at the same time, right? The blue one is the one we bought. This is the one we bought. And this is the one we sold. This is the point of entry. As time moves forward, right? As time moves on, if nothing changes, the value of this option will decrease, assuming it's out of the money, faster than this one, because this one has more time. And time decay speeds up as you approach expiration. This is the expiration of the first dated one, the one that we sold. And this is why we always sell the one that expires first, because the one that expires first is going to decay faster than the one that expires later. And so as time moves on, these will get further and further apart in value, and they will have the maximum distance between them at expiration of the first one. Because this one will go to zero if it's worthless, and this one will have the most value in comparison to this one at this point. After this point, this one will just continue to decay. So what we have here at this point is we have max value with all other things staying the same. And by other things, the two things that we're caring about are the price of the underlying stock and the implied volatility of the stock. If those two things stay the same, then this will be the point where we have max profit, and we will want to get out of the trade when this is expiring or about to expire. We will then have our max profit on this spread. Now, if price changes, it will affect these curves. And if volatility changes, it will affect these curves. Now, the way we look at this is that we basically want to take these calendar spreads, always buy the further out one, always sell the closer one, and exit the trade at or before this sold option expires. Now, if price and volatility are changing and we get a good enough profit for our trade strategy before this one expires, then we might exit the trade here and say, this is where we think like we've gotten enough out of this. We think the price or the volatility might change against us. We want to get out of it here. Same as we do with any other trade where we might set a profit target and say, we'll get out of it if we get enough distance between these that we hit our target. We don't have to wait till we hit the expiration for this. But we don't really want to go beyond the expiration of this, because then we're definitely just going to continue to lose value unless this one happens to be in the money. And, there's like odd cases where we might sell one and keep the other. But you should generally go into these until you get to the point where you're doing advanced trading. You want to go into these under the assumption that these two options are a pair. They represent one trade strategy, one idea. And when you exit one, you exit the other. All right, this is what it looks like when you get into it. You're buying the 20 April of a ticker. You're buying the April 20th call at a particular strike, and you're selling the same ticker, an earlier dated expiration of the same strike and the same type. Now, this will always be a debit. You will never take a calendar spread that is a credit. If you get a credit for a calendar spread, you did something wrong. Here's a little chart to help you figure out what your risk is and stuff like that. The big difference, another big difference with a calendar spread, is that you cannot really easily calculate what your profit potential is. You really need a tool like Option Strat to graph it out to show you what your profit potential is. It's really complicated to figure that out. And as time moves, as price moves, and as volatility moves, it all changes. So it's very difficult to set a real solid price or profit target on a calendar spread when you get in the spread. We're generally getting in a calendar spread because we expect volatility to change, or we expect lack of change in the price, certain things like that. But we're generally trading volatility, and so we look for the volatility change to get out of the spread as opposed to a particular profit to get out of the spread. So as I mentioned, and I just put a slide in here to make sure that that's part of the lesson, calendar spreads will always be debits because we're always buying the longer dated option, which is more expensive than the closer dated option. So we're always paying a net debit to get into the trade. All right, let me see if you have any questions before we move on to the last thing. Yes, the links to the replays are always going to be for the same for opening playbook and closing playbook. They're the same set, the same page. That's your replays page. If you want to actually see the slide deck, we'll post that in the opening playbook members area. Now, the opening playbook members area is uh, has a cost of a whopping dollar for lifetime membership. If you're not a member of the $1 opening playbook club, uh, reach down deep into your pocket, pull out the four quarters, and spend a dollar on that because there is a ton of training and resources in there, tools and everything. It is worth so much more than a dollar. It is worth more than $100 to get that membership. And it's not just like a dollar for today, it's a dollar for life. So get that. And you'll also have access to not only the replays, which everybody has access to, but you'll have access to the slide decks as well. Okay, so when we talk, Shirley asked, what do you mean if volatility goes your way? Do you mean you want it to go up or you want it to go down? Do you want the stock price to stay the same? So um, this is very easily kind of demonstrated on option strat, and we're kind of running out of time here, so I don't have time to go into it and show you visually how that works. But basically, what happens is when you buy the when you buy options and volatility is low, then what you're doing is you're paying for a small move, a small expected move. And then if volatility is going to go up, that will help your calendar spread because if you buy something with an expected move, let me go back to this right here. If you buy something with an expected move, and then as time goes on, volatility increases, what's going to happen is as volatility increases, this curve is going to change to this, and this curve is going to change to this. And so as volatility increases, you get a better gap. So ideally, if you expect volatility to go up, you're good getting in on a calendar spread when it's still low, because as it increases, your gap potential, your profit potential increases. So ideally, you want it when you expect volatility to go up. Now, it doesn't necessarily mean it has to start out quote unquote low. It just means that if it's going to go up, it's going to work in your favor. So it could start out at 20. If you think it's going to go to 25 or 30, you could still get in a calendar spread and make money on the volatility change. If it's at 25 and you expect that's the top, that's a bad time to get into a calendar spread because then this is just going to collapse on you, right, and get smaller. But you've paid for the volatility when you got in. When you bought this option, you paid for high volatility. If volatility goes down, then this gap shrinks and you paid a lot for a small profit. And so your ROI will shrink. So you want to get in when volatility is lower and expect it to go higher. And then price-wise, price has a little bit different effect on it because this is really a volatility play. So price is going to have a little bit of a different effect on it. It's going to affect your percentages more so than your profitability because the profit. Now, what you generally don't want is you don't want these to uh, you kind of don't want to end up in like this middle zone, which is hard to really describe because it's not a middle zone of price. It's a middle zone of value compared to time. And it's really a hard thing to do, like even intellectually or manually. You really need to look at a tool like Option Strat. And I'll show you that super, super quick because we're running late and I'm really not supposed to do that. I'm going to get yelled at. But I'll show you very, very quickly on Option Strat what that looks like because I've mentioned it so many times here. Let me get out of this presentation. Give me 1 second, and I will show you what I mean by visualizing it on Option Strat. Okay, so let me share that instead very, very quickly. So if we go to this Option Strat tool that I've mentioned numerous times, and we go to build a trade, Where's calendar? Let's do calendar call spread like we were just talking about. Let's just say we're doing it on the SPY. So here it's giving us May 8th and June 18th. So we'd be selling the May 8th because it's closer and buying the June 18th because it's further away. We would generally want the strikes to be the same. We generally want the strikes to be the same. And what this shows us down here is what our profit zone is, which is in the reds. Let me change this to percentages. Oh, the percentages are over here, right? So, well, this is a percentage change, and this is profit versus loss. So, there's a place to change it to percentages, and I don't know very quickly where it is. I don't remember. Oh, here we go. Okay. Nope, that's not it. All right. We'll just go quickly here. So if we were to, let's say, put this up here and choose these strikes, you could see how it would change things. If we look at a different range of profit movement, if we change implied volatility. So you can see if we start out down here, right, and volatility goes up, you can see how the volatility is affecting our profitability, right? As volatility increases, it affects our profitability, right? As the price changes, so let's go to kind of a middle zone here. So you can see as price changes up and down, we win more at certain prices in the middle, but we start losing as we go further away. So as price moves in either direction, we start to lose some of our profit. So this really helps you visualize, well, if I place this exact trade, where are my profit zones? Where are my loss zones? When do I start losing money if volatility changes to this number or that number? If I want to look at more movement, less movement on the price, and so on, this tool really helps you figure all that out. Okay. Um, so diagonal spreads, Ken, we don't have any trainings on diagonal spreads that I know of. A diagonal spread, for those who don't know, is a combination of a vertical spread and a calendar spread where both the strikes are different as well as the dates are different. So if I were to do something like this, would be what we call a diagonal. We're buying a 680 and selling a 685, but they're two different dates. So we're buying a 680 June 18th and we're selling a 685 May 8th. That's what's called the diagonal because not only are we taking two different strikes on the vertical chart, we're taking two different dates on the horizontal chart. So it makes it a diagonal. And at the moment, we don't have that. Where you can find that, I take that back. Where you can find that is on this site. It is the options education on Tucci trades. Give me 1 second. And I'll find the URL for you. Options on Tucci trades. Where is it? Right here. So if you want to do some additional options training, you can look here. All right. Let's see. Lynn, no, the replays aren't labeled with the contents for that day. But if you go into the slide deck doc, it'll show you the slides from each day, and you can kind of find the lessons that way, and then go back to the replay for the full explanation. All right. So the last thing we're going to do today is give you an opportunity. If you're not in Graham's perfect income trade alerts, those come out on Fridays, which is today. If you want to get in today's perfect income trade, where we get in the trade on Friday each week, and it's really a great program. It's a weekly program from Graham, complements his daily 60-minute program, complements a lot of his programs and Nate's programs. We're going to show you that presentation that Graham and Nate did on perfect income trade alerts.
get in, you guys know the drill. Profits, performance, not typical. We're not going to guarantee any future earnings because, of course, you could lose money on any trade that we talk about. But every single trade here is based on real trades sent out in real time. This is not a back test. It's not paper money. The average return here, winners and losers, 32% per trade in 4%. Guys, that's winners and losers. That's the average return we were talking about. 66% win, and there's my favorite number, an average win of 93%, even though most of these stocks barely move. So obviously can't guarantee specific future results. There's always a high degree of risk. If you want to go through, just go to Prosperity Pub and you can read all of that. So welcome. If you guys don't know me, I'm sure you do. I'm Nate Tucci. I'm the publisher here at Prosperity Pub. And when most folks are paying, $500,000 or even more to trade popular stocks like Apple, Nvidia, or Google, one Florida-based trader discovered a new way to tap into what could be some of the most cheap options in the market that you can take advantage of. Trades costing right around $1, right around a good George Washington there to get in. And with this unique trading method, he's been able to watch as these trades double in just a very short move each and every week. In fact, over the last 18 months, he's already done it 58 times, including multiple doubles on some of the stocks I just mentioned, like this dollar trade on Apple, which costs $1.24 to get in and paid